Been wanting to make this YouTube video for about 2-3 months now, and finally I had the chance to just film this video for this YouTube video. Hey, what's up guys? My name is Andrew and I am 20 and I currently attend the University of Texas at Austin. I've been investing for about 2 years now since I turned 18, and I've had a little bit of experience in investing and stock trading. On top of that, I'm also a real estate agent in Texas, and I help UT students find housing around the UT campus area. So the main topic in today's video is going to be long-term investing, mainly passive investing, and it's going to be talking about the S&P 500 and what I'm going to be recommending that you do in order to invest long-term and passively making money from the stock market. So let's get right into the video. Passive investing is a strategy that's used by many investors, mainly ones that want to just buy the stock and just hold it, and it maximizes profits by taking a low amount of risk, mainly purchasing stocks like ETFs and index funds that track the S&P 500, which I will be discussing later into the video. So what is the S&P 500? It's like a basket of Easter eggs, except instead of Easter eggs, it's individual stocks. So the S&P 500 is made up of the biggest 500 companies that are publicly traded in the US. As you can see, Microsoft is currently the biggest company that's publicly traded in the US, valued at about $1.3 trillion, which is a pretty big company. You can also see how much each company weighs in the overall S&P 500. Currently, Microsoft weighs in the most into the S&P 500 at about 5.8%. Right below that, Apple's the second biggest publicly traded US company with a market cap of about $1.25 trillion, and the S&P 500 weighs about 5.5% of Apple. The S&P 500 weighs the biggest companies the most and the smallest of the 500 companies the least. So let's take Nordstrom for example. It's at the bottom of the S&P 500, so it only weighs in Nordstrom about 0.007%. Although Nordstrom's a really big company, compared to the 500 biggest companies, it's the 500th biggest company, I guess, or maybe a little bit bigger than that. But in a nutshell, the S&P 500 weighs the biggest companies the most and the smallest companies the least. Now that we've talked about the S&P 500's composition, we're ready to invest into an index fund or an ETF, and we're going to be talking about how much money you'll be making on a theoretical analysis. Historically, on average, the S&P 500 yields about a 7 or 8% return. So if you invested $100 into the S&P 500 in 2020, at the beginning of 2021, you make about a $7 profit. So at the end of 2020 or the beginning of 2021, you will have about $107 or $108 in your brokerage account. Now, I want to clarify that historically, the S&P 500 has about a 7% return on average each year. So 7% isn't guaranteed. You do have to take on a little bit of risk by putting your money into an investment position. Let me show you what I mean by that. So if you invested into an index fund that tracks the S&P 500 at the beginning of 2019, you would have made a 28.88% gain. So let's just say you put in $100 at the beginning of 2019. You would have made $28.88, which is much higher than the average 7% or $7 profit. But you do have to keep in mind that in 2019, the economy did very well in the US. So let's take 2020, for example. Let's just say you put $100 into the S&P 500 at the beginning of 2020. then you would have lost about 11.36%, which is about $11.36. So from the beginning of when the S&P 500 was created, which was in 1957, on average from 1957 till present day, it has balanced out to be a 7% return. So now that we've established the S&P 500's annual yield, let's translate that into terms of money. If you invested $10,000, you would be making about a $700 profit, because 10,000 times 0.07 or 7% is $700. So a $700 profit minus taxes and without dividends reinvested. So while 7% may not seem like a lot, because for a $10,000 investment, you're only making about $700 in profit. But you do have to keep in mind that you're going to be investing long-term. So over time, that $10,000 investment is going to be compounded each year. So that was just 1 year. Let's expand that into 10 years instead. So if you invested $10,000 once, at the end of the decade, you would have made a $9,670 profit. Now let me show you what the S&P 500 looks like visually over time. Now what I'm showing you right now is the logarithmic scale. This may not seem like it has an exponential growth equation you're used to seeing, but as you look to the left, the intervals do tend to get smaller as it increases by 500 points. Now let me show you what the market looks like on a regular interval scale. Now, as you can see, on a regular scale with inflated adjustments, you can definitely see an exponential growth in the S&P 500. Now this is what the S&P 500 looks like without inflationary adjustments. Really, any stock tracker that examines the historical trend of the S&P 500 will show this graph by default. So now that you know how much the S&P 500 is made up of and how much you can potentially gain from it, which specific ETFs or stocks should I invest into? I'm actually going to be giving you specific ETFs and index funds that specifically replicate the S&P 500, and I'm also going to be comparing the different asset management companies that you can invest into. Index funds are a type of mutual fund that can be bought only under an asset management company. Currently, Vanguard is the most popular and is the biggest global provider of mutual funds. The specific company index fund that tracks the S&P 500 is called the VFAX. Another asset management company that provides a similar index fund similar to VFAX is Fidelity, which has like an equivalent S&P 500 index fund called the FXAIX. The biggest difference between Vanguard and Fidelity's index funds in this case is that Vanguard requires investors to purchase the S&P 500 index fund at a minimum of $3,000. So you need a minimum of $3,000 if you want to buy the index fund. With Fidelity, there's really no minimum investment. So the clear winner here is Fidelity for investors that really don't have that much upfront money. Now that you know which index fund each asset management company provides, let's look at the expense ratio. The expense ratio is an annual fee that's used to cover operating costs for the asset management company, such as management fees, administrative fees, and other various expenses. Currently, Vanguard's S&P 500 Index Fund, or VFAX, charges about 0.04% annually. The expense fee cost is the average price of the index fund multiplied by the ratio. On the other hand, Fidelity's expense ratio for the S&P 500 Index Fund, VXAIX, is 0.015%. Now, if you're concerned about the fees involved with purchasing index funds, typically, in reality, as long as it's under 0.2%, you should be fine. The S&P 500 index funds I provided are well below 0.2% since they're passively managed and don't have that much operating costs. Now let's look at exchange-traded funds, also known as ETFs. The biggest difference between an ETF and an index fund is that ETFs are traded like stocks, so they can be bought on any brokerage account, and it doesn't have to be purchased directly through Fidelity or Vanguard. So we're actually going to be looking at Vanguard's ETF equivalent to the S&P 500 index fund, which is called VOO. It's currently priced at around $270, and the expense ratio is 0.03%. Since ETFs are traded like stocks, if you don't have that much money, it still requires a much lower upfront investment since each VOO share is about $270. So if you only have that much money that you can invest with, you can purchase one share versus buying Vanguard's index fund, which requires a $3,000 minimum upfront investment. So after doing a little bit of research, Fidelity doesn't actually have an ETF for the index fund since they don't require a minimum $3,000 upfront investment like Vanguard does. So since they don't require a minimum upfront investment, they don't really need an ETF. So while Fidelity is a better investment for index funds, Vanguard is actually very innovative with their ETFs. They offer multiple types of ETFs that can track the S&P 500, each one with different exposures and company weight, which I'll be going through a few. The first one is the S&P 500 Growth ETF, also known as VOOG, which puts more emphasis in the S&P 500 companies that tend to have the highest growth rate historically. The expense ratio for that is 0.1%, so still pretty low. The only caveat for growth ETFs is that they tend to have a slightly higher volatility. The second ETF is the S&P 500 Value ETF, also known as VOOV. This ETF tracks companies that typically don't make as much in profits since they're not going to be growing as much in the future. The price of these value ETFs are much lower since you're paying for value and not so much for growth. Again, the expense ratio for this is 0.1%. Other various S&P 500 ETFs I would recommend is SPY, also known as SPY, and IVV. And if you're looking to invest into the S&P 500 specifically for dividends, then I would highly recommend SPYD. So as a recap, I'm going to be discussing what we talked about in this video very briefly. I'm also going to leave it down in the description below if you're looking to maybe just copy and paste it into your notes. So the S&P 500 is made up of the 500 biggest US publicly traded companies. The biggest companies have a larger weight in the S&P 500 than the smaller companies in the index. This allows for automatic diversification in your investments. The S&P 500 on average grows about 7% annually. This has a compounding effect, so it grows exponentially, which means if you invest into the S&P 500 over a 10-year period or just a decade, theoretically you would have doubled your money, about 96% growth on your initial investment. Asset management companies such as Vanguard and Fidelity offer exclusive index funds for investors on the trading platform or application, with Vanguard requiring $3,000 minimum investment and Fidelity has no minimums. ETFs are traded like stocks and can be bought on any exchange application. So on top of that, they have a much lower investment threshold for investors that don't have as much money, and it's much more accessible for people who don't personally use Fidelity or Vanguard. With that being said, if you enjoyed the video, please leave a like and comment down below. If you didn't, leave a dislike. And if you want to see more content like this, please subscribe and hook 'em.